We have a quick question here from Wojciech asking us to elaborate a little bit more on the term quad witching day. So as always, Wojciech, thanks for the question. Now, as you know, there are various ways that you can trade individual stocks and equity indices. You can either trade them as a CFD through your broker, but you can also trade them, of course, as an option with an options contract or a futures contract. Now, the difference between trading a CFD and trading it as an option or a futures contract is that options and futures contracts expire. So for stock options and equity index options, they usually expire the third Friday of every month. But once a quarter, so that'll be at the end of March, at the end of June, at the end of September, and the end of December. On that third Friday, you also have stock futures and equity futures expiring on the same day. Now, because you have so many options and futures contracts expiring all at the same time, it can often result in very choppy price action. With some exacerbated moves to the upward to the downside. Now, there is usually a noticeable increase in the volume on these days because market participants will need to decide whether they will roll their futures contract over and maintain that position in a non-expired contract. So going from the June contract to the July contract, for example, or they can choose to completely close out their futures positions, which can be a buy or a sell depending on the direction of the original trade. So why is this important for us as currency traders? Well, it's important from a risk flow point of view. So if we see exacerbated price moves in risk assets like equities and stocks, we can, of course, expect some spillover effects into the high betas as well as the safe haven currencies from risk sentiment point of view. So definitely something to keep in mind. Also keep in mind that the challenge with these types of days is, it's kind of like fishing, trying to catch fish by shooting them with a shotgun. So eventually you'll probably get lucky and catch something, but for the most part, you're shooting blind, and there's no way of really knowing which way the price will go. So it's a little bit of a hit and miss trying to trade them. And then, of course, if you throw in, potential short-term risk-sensitive catalysts into the mix, it can really be a very messy picture overall. So generally speaking, your biggest reactions from these quad witching days will occur at the year end or the December one. At the December expiries, of course, traders will look to square out positions going into the year end to try and square off their books. But depending on the overall flow of the markets, any quarter has the potential to see big moves. So in today's session, for example, we can see some analysts are citing that there is almost 1.8 trillion S&P option contracts, or $1.8 trillion worth of S&P option expiry contracts or options that need to expire, which makes it one of the largest mid-year expirations on record. But at the same time, you can see that there's very little open interest, and open interest is within 10% of the spot price. So it's big, but it might not be that big of an influence in the market. So we'll need to wait and see what happens. So these days don't necessarily always translate into big moves. As some of those positions can, of course, like probably in this case, can already be squared or rolled over a week or a couple of days or maybe a couple of hours before the actual expiry takes place. But that should give you an overall view, Wojciech, of what we mean with quad witching day and how it can affect the overall flow in the market. Any other questions, as always, don't hesitate to let us know.